The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Welcome back, American Family Radio, Financial Issues. I'm Dan Celia. By the way, all the major indices in positive territory. The Dow's up 13, Nasdaq's up 11, S&P is up 2. So everything in positive territory, that's good news. Looks like Caterpillar stock is probably going to do real well. They came out with some good earnings, some good reports. They were upgraded. Caterpillar is one that I'm still debating whether to get back on my list. They are not on my list. They were on my list for 30 years. They aren't any longer because of their support. I did find their support of the redefinition of marriage. And I did have a conversation with them finally, but still pushing that and trying to get some more answers. So anyway, there's not a whole lot of news coming out of, companies or anything. It's going to be a quiet week, folks. There's not going to be a lot of volume to speak of. It's very typical this week. So don't expect to see a lot of volume. When you don't have a lot of volume, you have no conviction either way. You don't have any conviction on the upside. You don't have any real conviction on the downside. So if the markets go down 200, 300 points one day, Monday, Tuesday, or Wednesday, it's going to be relatively meaningless. If the markets go up 200 points, in my opinion, in those 3 days, it's going to be relatively meaningless. Because with volume means a whole lot of people, right? How many people are actually buying and selling? So the reason we care about volume, because it indicates, wow, there's a whole lot of people believing that things are good or believing that things are bad, whatever. Believing that this particular economic data was good or believing this particular economic data was bad. Volume shows a consensus or a conviction. So volume is important. We're not going to see a whole lot of volume this week. You can almost count on it. So, I'm not going to talk a whole lot about the markets because it's to even give out, say what the numbers are almost meaningless. So you're not going to hear a lot of that Monday, Tuesday, or Wednesday. So I'm just kind of giving you a heads up on that. I'll take a quick look at commodities just to say that for all the talk about oil coming down, it was 93.53 when we opened. It's now 93.44. So it's coming down a little bit, and it is trending down. It is moving down as a result of this so-called deal that the United States has made with a terrorist group called the country of Iran. So apparently the oil market appreciates the negotiating with terrorists that we've done, and they appreciate and believe, kind of like the Obama administration and Secretary Kerry, that surely terrorists would never lie to us or never not do what they say they're going to do. So the oil industry feels the same way. Oil buyers, future traders, believe the same. They're of the same ideology and mindset of John Kerry and the Obama administration. So that's all I can say about that, because that's probably about as close to the truth as you're really going to get in all of that. Anyway, 866-300-9298. 866-300-9298. You're listening to American Family Radio Network, Financial Issues. I'm Dan Celia. We are going to try to stay with the phones. Let me go to Jonathan. Jonathan's calling us from Iowa. Hey, Jonathan.
Good morning.
Good morning.
I just had a two-part question.
Okay.
What's the GDP? Because you said that the government had two different departments that were giving two different numbers. Mm-hmm. And then I heard, I don't know if it's your show, Brian Fisher was saying the deficit's not 17, but over like 86 plus trillion because they're not including Social Security. Could you elaborate on that?
Well, the deficit is in fact 17 trillion. But then when you looked at, so you can't, from an accounting standpoint, I'm just a math guy. So from an accounting standpoint, you can't include necessarily unfunded liability as a deficit because of the first word, unfunded. In that, and meaning unfunded means we have the liability that we can't afford, but the liability is also not, we're not drawing upon it, we're not spending it, we're not using it, so it's not really going against the deficit because it hasn't been spent yet. But it is a real liability. Now, I don't know, where all the numbers come from, but the unfunded liability, I can only know where my numbers come from. And there is a consensus out there, probably more than not, that the unfunded liability is probably just over about $105 trillion. I can only get to 88 trillion. Now, maybe I'm not privy to the same information that a lot of other economists are. And that's a possibility, I guess. But I can't do the math to come up with that number. So I'm sticking to, in the 80s, is the unfunded liability. That's on top of the 17 trillion deficit that we already have. So the deficit is we're running in red. When the unfunded liability of 88 trillion starts to get into our pockets now, then that is going to go against the deficit. All of it, the 17 trillion of deficit that we currently have, and the unfunded liability, all of it is in fact a liability to the American people. There is no getting around it. So the majority of that unfunded liability comes from Medicare, Medicaid, Social Security, and the Farm Bill, which is food stamps. That's where the majority of it comes from. So the interesting part about the unfunded liability is that it does not yet include Obamacare. So anything from an entitlement program standpoint that is going to happen as a result of Obamacare is not included in the unfunded liability. So what's going to happen that we already would be able to do an accounting of today if the government or the CBO decided to. We already know that Medicaid has increased dramatically as a result of Obamacare, because people that have never been able to qualify for Medicaid are now on Medicaid, or at least qualified for Medicaid as a result of the website when they've gone to try to sign up. They've been almost pushed into Medicaid. So the unfunded liability is going to increase dramatically. And by saying dramatically, I think it's a huge, huge, huge understatement. In my opinion, I believe that and I've said this before the bill was passed, that I believe that Obamacare was going to be the final nail in the economic coffin of the country. And I believe that to be the case. Still do. So we're not even close to seeing what the real unfunded liability is going to be. Part of that is Social Security. I am not in the camp. There many are. I am not in the camp that Social Security is an issue, because Social Security is incredibly easy to fix. And I think we can fix Social Security. What we need with Social Security is a will to fix it, which we don't have in Washington. But if we had a will to fix Social Security, that would be relatively easy. But nevertheless, yes, we have that debt. As far as GDP goes, I don't know what GDP is going to be. My original estimate back on January 1st, just for clarification, so if I'm wrong, I'm wrong, but I said it was going to be 1.9% this year. That was my prediction for the year. Right now, we're standing at about 1.9%, give or take. So, but we don't have an accurate, I don't know if you believe any of the numbers are accurate, we don't have an accurate number from the government on third quarter GDP yet. We haven't gotten the final look yet. So I don't know what that's going to be. When you have heard me say that there are two numbers out there as far as GDP goes, what I'm referring to there is the way we calculate inflation to GDP. That's one thing. The other thing is we now, as of July 1st, and I'm the only person talking about it, but as of July 1st, the government changed the way they calculate GDP, or not necessarily the way, but what they have done as of July 1st is include other things that should not be included in GDP into GDP. Because, again, this is an opinion of mine, this part. In my opinion, the government is desperate to try to get to 2.5% GDP growth or higher. They can't get there. So when the government can't do something, they change the way they calculate it. That gets them there. So the point is, if we see a 2.5% GDP growth come January for this year, then it's going to be, or more, it's going to be, in my opinion, because of what we are now including. And we are including things in GDP that we're the only nation in the world that is including some of these things. And they're not truly related to the manufacturing or the production or the hiring or the growth in the economy. So, in other words, if you rent a movie from Netflix, that was never a part of GDP. It is now. Here's the problem. When you when you rent that movie or whatever you do, I'm not sure how all that works, but when you rent that from Netflix, you didn't create a job. You're not helping. You're not doing anything for the gross domestic product of the nation. So that's another area. So the differences that I'm talking about are the way we calculate inflation. So when you hear on other programs, I'm not talking about other programs on this network, although you may hear it here on this network as well. But when you hear from other folks about financial information that is talking about GDP, keep in mind it is based on an inflation rate. So GDP is about we'll say it's about $14.8 trillion. That's how much money it is worth. All the GDP, all the gross domestic products, goods, and services that we produce here in America. So it is based on an inflation rate. Well, years ago, it used to be based on CPI. You know what CPI is. Everybody knows what CPI is. We see CPI. Well, CPI, there's another thing that the Commerce Department uses called the GDP inflator. And it's a different inflation rate. And for the last 30 years, the GDP inflator and the CPI have been relatively the same, except the GDP inflator from the Commerce Department changed slightly. It's just off just a tenth. Well, when you multiply that over 30 years, you come to the realization that because of the inflation rate they're using, if you believe that CPI is correct, which I don't, but if you do, then our GDP is really something closer to 13 trillion, not 15 trillion. So that changes our debt to GDP ratio. Hence why the government wants to use the other inflation factor to make sure GDP is as high as it possibly can to keep that gap between the debt that we have and inflation as small as possible. And that is one long answer to a relatively simple question, but it was one of those teachable moments that I felt it necessary to go into the detail. Sorry about that. Let's go real quick to Kelly from Texas. Hey, Kelly.
Hey.
Go ahead, Kelly.
Hello. Hey, Dan. How's it going?
Good.
Well, last time I talked to you, I asked you about my 401k, and you had told me to invest in, I think it was a large cap value.
Right.
And a short-term bond fund.
Okay.
You told me to do it about 60, 65, 30.
Okay.
Favoring the large cap, I think. Through my investments, they only have like an intermediate bond fund, and I think it was like a long-term bond fund or something like that.
Okay.
Would you recommend the intermediate instead of the short-term?
No, or especially not the long-term either. But then if they don't have a short-term bond fund, do they have a money market account?
Yes, sir. Yes, sir.
Well, then I would use the money market account, Kelly.
Okay.
When I said short-term bond fund, I just probably assumed that they didn't have a money market account because so many 401ks are going away from that. So I would set it in the money market account, and if you've got a long-term horizon, the large cap value should be okay, but there is going to be fluctuation on the downside. Don't panic. Just keep contributing to it. But use the money market account there instead. Thanks, Kelly. I got to run. Thank you for the call. Great stuff. 866-300-9298. You're listening to American Family Radio Network, Financial Issues. We got news coming up. We're going to go right back to the phones right after that break.